Hey everyone, welcome back to this week's episode of Toast and Topics. Today, Sachin and I wanted to research the national debt of the United States, a subject which has attracted considerable attention recently as Congress negotiates over the Big Beautiful Bill. We wanted to take this episode to revisit our understanding of the national debt, to discuss the reasons a country should or shouldn't run large deficits, and to flag the key issues that should be on the minds of policymakers at the current junction as we consider approving new government spending for this year.
That's right. And I'm very excited to get into the mechanics of this issue, as always. And before we jump in, this is a very special episode because Ben and I are recording live in Washington, D.C. And I'm here visiting him as part of what's turned into an annual trip of mine to our nation's capital. So it seems like a very fitting venue to be talking about this topic in particular. So, without further ado, let's get started. Kicking off with the basics, national debt is very simply the accumulated money that a country borrows to meet its spending in the present. And as we've talked about in prior episodes, for governments, the debt can be driven up each year by a deficit, which is really just the difference between what a government spends and the tax revenue that it earns every year. And I think that when many people hear the word debt, they understandably view it with a bit of a stigma. It is bad to be in persistent debt as an individual, but the equation may change for governments depending on their specific circumstances. It can often be sensible for a government to spend more than it earns to support the economy, for example, to fund defense spending or the growth of infrastructure or other similar priorities. And the government can raise money to finance this spending by issuing bonds, which it promises to pay interest to investors over a fixed period down the line. So it's often a win-win for everyone. The government can use the additional funds it borrows in the present to support the economy, while investors can purchase those bonds and earn interest on them, which is generally considered a safe way to, allocate savings for certain people.
Yeah, all of this is true, but the important point is that these spending obligations need to be relatively stable. A key metric that many focus on in this regard is what government debt is as a share of gross domestic product, the output of an economy. And the funny thing about how national debt works is that the government can be spending more than it earns every year, accumulating debt in absolute terms, but so long as its economy grows fast enough, its overall level of debt as a share of GDP will remain constant. And so a government can, in essence, have increasing debt and with some economic growth and a resultantly larger tax base, also the means by which to pay it down. And that's really what I describe as being a good sort of debt. But the question then becomes whether the situation that we face in the United States can be placed under that umbrella or not.
Yeah, just for reference, in 2015, public debt stood at roughly 70 to 75% of GDP, and that's a high level historically, but was still fairly manageable. And fast forward to today, public debt is at about 100% of GDP, and that number is even higher if you include the debt that the government owes to other parts of the government, such as the Social Security's trust fund, as an example. So in total, including those internal loans, U.S. federal debt is over 120% of GDP as of late 2024. And this is the highest level of debt in U.S. history, with the exception of the period immediately following World War II. Now, over the past 10 years, the US has run large federal budget deficits every single year. In the mid 2010s, annual deficits were relatively moderate, on the order of 2 to 4% of GDP, having come down from the Great Recession stimulus levels. However, deficits began rising again in the late 2010s due to policy changes and spending increases. Notably, the Tax Cuts and Job Act of 2017 reduced tax revenue, and bipartisan budget deals increased spending on defense and domestic programs, both of which pushed the deficit higher. And by 2019, the year right before COVID, the deficit was near $1 trillion, which was a significant jump from mid-decade levels.
The US is therefore running what analysts call a structural deficit, meaning that even in normal times, not in recessions or emergencies, that is, we're spending significantly more than we actually take in tax revenue. The Congressional Budget Office, or CBO for short, projects that under current laws, we'll continue to run primary deficits, not counting interest, of over 3% of GDP each year for decades. And we mentioned earlier that debt sustainability is often viewed relative to the level of GDP and its growth. And if the economy is only growing at 2% per year, but the debt is growing at 3% per year, or even perhaps 5% per year if you're including interest, the debt to GDP ratio is going to continue to rise. There are a few economic reasons that the deficit remains so high in the US that are worth talking about. And this is demographic and aging population, and then resultantly rising healthcare costs, which have increased spending on programs like Social Security and Medicare, tax revenue not keeping up with that spending, in part due to tax hikes not being politically popular, and finally, higher interest payments, which is especially important as the debt itself has grown and as interest rates have increased in 2022 and 2023 in order to combat inflation, the government's interest payments have surged, which adds to the deficit without even necessarily growing the primary deficit. In 2023, the US paid an all-time record of 658 billion in interest on the debt, more than it spent on national defense that year roughly. And interest costs are now about 18% of all federal tax revenue. Higher interest costs are a legacy of past borrowing, our accumulated debt, and it's a new burden going forward. They make deficits harder to shrink. This was not an especially large issue in the 2010s when our interest rates were nearly zero, making it the case that we really never had to spend much on interest payments, even if the principal amount of the debt was large. But in an era of higher interest rates, this is actually quite a big issue.
Yeah, it's turned out to be. And I think that this is a good transition to start talking a bit more about the concept of debt sustainability, which is an important one to think about when hearing numbers as large as the ones that you've highlighted, Ben. And the true answer is that there's no single magic threshold that countries can optimize their debt at, which is the ultimate conclusion that most economists have come to after years of debate. Conceptually, though, there's a fine balance to strike between a country's debt load versus its economic growth and interest rates. And one fascinating case study that I think is interesting to refer to is Japan. Japan has the highest debt to GDP ratio in the world, over 250% of GDP by some measures. Um, Yet Japan has never really experienced a debt crisis or hyperinflation or an inability to borrow. And the key lesson that Japan can teach us is that debt sustainability depends more on simply the debt ratio. Japan's a unique example of a country which was able to keep interest rates exceptionally low and near zero for many years, which I know we've talked about in previous episodes. And that's allowed them to keep their interest payments at a very manageable level. In fact, Japan's interest payments have been on the order of 1.5% to 2% of GDP per year, which is less than what the US pays with 100% debt to GDP ratio. Additionally, there's a unique dynamic in Japan that allows it to run a large deficit without any problem, which relates to actually who holds the government's debt, which I think is pretty interesting. Much of Japan's debt is actually held by its own citizens and institutions, such as its central bank, other commercial banks, or insurance companies. And this home bias means that Japan isn't reliant on foreign investors, which could be more fickle and may suddenly withdraw their capital. By contrast, about a third of US debt is held by foreign investors, which could, in theory, be a source of uncertainty if those investors potentially lose confidence.
That's really fascinating, Sachin. Another point on Japan that I've read about is its high rate of private savings. Japan's private sector saves a lot. Japanese households and companies tend to hoard cash and have been cautious with their spending. Household financial assets in Japan are enormous, which means that there is a lot of domestic capital that's simply looking for safe places to park, and Japanese government bonds really do fill that need. I guess the lesson from Japan is that high debt alone doesn't guarantee a crisis. If you can manage interest costs and maintain creditor confidence, a country can actually operate with very high debt for a long time without any real issue. And the real measure of debt sustainability is whether the government can continue servicing the debt, paying interest and rolling over bonds without an ever escalating burden on its budget or a loss of confidence that forces painful adjustments.
Yeah, this all raises the question of whether we're at that stage for the US, i.e., whether our deficit is at the point of triggering that potential loss of confidence. Just about a month ago, Moody's, which is a credit rating agency, downgraded the US sovereign credit rating by one notch from AAA to AA1, making it the last major ratings agency to downgrade the US debt. Moody's explicitly pointed to the rising debt and interest burden that make the US an outlier among large developed countries when it made that decision. And while the credit rating alone is not an end all be all, a downgrade is a signal of potential reasons uh, to at least raise eyebrows. And from an economic theory perspective, if a credit rating downgrade triggers that crisis of confidence we talked about, foreign investors could potentially start to demand a higher premium to hold debt, which would increase the deficit further. Um, in fact, the CBO estimates that a 1% sustained increase in rates would raise interest outlays by $2.6 trillion over 10 years, which is pretty staggering. Beyond raising taxes, there's really only one solution to bring debt back to quote unquote sustainable levels that we've talked about. And that's by pursuing policies to boost growth and productivity. And the math behind this is fairly simple. If the country's growth rate exceeds the interest rate on debt, then the debt to GDP ratio has a chance to stabilize or even fall over time because the denominator in that ratio grows faster. And this was the case in the 1950s, post World War II. But currently, interest rates have risen and are actually higher than the growth rate, which means that debt to GDP could continue to rise unless we either run smaller deficits or, number two, boost growth.
That's really interesting, Sachin, and ultimately very thought-provoking. The outcome for all of this for everyday Americans is that increased rates could ultimately be passed on to them in various aspects of their lives, in the event that interest rates remain high in order to deal with the debt. Mortgages are a good example of that because home loans are tied to US Treasuries. Longer term increases in interest rates could be passed on through higher borrowing costs across many pockets of the economy, which would certainly be a damper on growth conditions. The result of this could also be higher inflation if the increases in debt are actually monetized, or in other words, spent by the government. And there are a lot of things to spend on in a world with rising geopolitical tensions, fractured global trade and reshoring, aging populations that require significant social spending outlays, and a growing military set of expenditures, as well as the AI revolution.
Yeah, that's right. And I guess the conclusion here is that yes, debt levels are high today, and yes, it could be a problem if growth were to slow. But at the same time, we've been in this position before, and there are ways to manage it down. And just because the debt trajectory in the US has been increasing, it doesn't necessarily mean that it has to end dramatically if expectations are set right, as in the case of Japan. So we'll obviously see how this plays out over time, and I'm sure that this is a topic we will revisit yet again here.
Yeah, indeed, we will. Well, thank you all for joining us on this week's episode of Toast and Topics. We are going to be taking a short hiatus for the next few weeks. I'm soon going to be moving apartments on my way toward living in California fully. And following that, both Sachin and I are going to be traveling on vacation, but we'll be back refreshed and re-energized for more content coming your way. And we're working on some potential interviews that are in the pipeline. And so if you're someone who's interested in being interviewed on the podcast, please reach out to us on our social media or via email. Thanks again, and we will see you soon. Thanks for listening to this episode of Toast and Topics. Before signing off, we wanted to disclose that the views expressed in this podcast are not representative of the organizations that we are associated with. If you learned something in this episode, please share it with a friend or leave us a review. Until next time.